Good evening all. I myself CMA Vinayak Kulkarni along with CMA Ashish Bhavsar welcome you all for this series of webinars on income tax. Today is the 10th session of our series. The topic for the today's session is taxation on virtual digital assets. The speaker for the entire series is CMA Dakshin Sokshi sir. I welcome our today's speaker, CMA Dakshin Sokshi sir. Sir, over to you.
Good afternoon, everyone. Just give me a moment to share my screen, please.
Okay.
Screen sharing file. Right. Wait a second. Is my screen visible now?
Yes. You can continue, sir.
Okay, just a moment. So my PowerPoint presentation is visible, right?
Yeah, you can
Okay,
continue.
fine. Good. So today's topic is taxation of virtual digital assets. So as we know, cryptocurrency has become talk of the town now. Cryptocurrency is a digital currency in which transactions are verified and records are maintained by a decentralized system using cryptography rather than by a centralized authority. So Financial Action Task Force, the Financial Action Task Force is the global agency who takes care of global money laundering and terrorist financial watchdog. So they have shown certain concerns about the use of cryptocurrency. They said that blockchain, Bitcoin, crypto assets, virtual currencies are a whole new vocabulary describing innovative technology to swiftly transfer value around the world. The blockchain technology is fast evolving and distributed ledger technologies have the potential to radically change the financial landscape. But their speed, global reach, and above all, anonymity also attract those who want to escape authorities scrutiny. So as we know, under cryptocurrency, the main fundamental thing is anonymity. Nobody knows who is the real holder and and whenever the transfer takes place, it becomes anonymous. So blockchain has originated just over 10 years, but since then, virtual assets have become widely available, have started to be used as a payment products. However, without establishing regulation oversight, the sector is often stirred as wild west of the finance industry because we know there are hardly any regulations which controls cryptocurrency. So this makes criminals misuse the virtual assets. So as we know, in 2017, the Venancy Ramset attack held thousands of computer systems hostage until the victims paid hackers a ransom in Bitcoin. The cost of the attack went far beyond the ransom payments and it resulted in an estimated USD 8 billion in damages to hospitals, banks, and business across the world. Other ransom attacks have also happened since and appear to be on the rise. So how such frauds takes place? First thing happens with the virus. they send certain virus which infect the computer system. It disable the business. Even in hospitals, they restrict the operations until a ransom amount is paid to them. So the virus is so much severe that once the system gets affected with that virus, there is no recourse available, and then the user has to make some ransom payments. So what happens? Victims pay the hackers a ransom in Bitcoin to decrypt their computer and resume their activity, because without that they are not able to resume their computer operations. So once the ransom payment is made to the hackers in a Bitcoin, hackers receive the ransom payments in a publicly identified Bitcoin wallet. Then happens a layering. Multiple transactions convert the payments from one virtual asset into another to remove all links to the crime. So this is how they are able to protect themselves, protect their identity. Then virtual asset service providers, then hackers send the cleaned bitcoins to a service provider or banks that convert the virtual assets into fiat money. And then happens conversion into regular currency. Hackers receive the bitcoins in the currency of their choice, ready to invest in a bank, and then they have got the real money. So this is how the fraud takes place, and cryptocurrency or the Bitcoin is used by such hackers to manipulate the systems and to recover the money. So why it is cryptocurrency is important for our country? As we see the various news items, India ranks second in terms of crypto adoption in the world. This is what the Mint reports. Then Economic Times reports crypto tech industry to grow to $241 million in India by 2030. So this is what NASOCAM has reported, has made a study that crypto tech industry in the country is likely to grow to $241 million by 2030. Then another is an article by Economic Times which reads that about 20 million Indians jumped into crypto bandwagon in 2021. So there is a substantial rise in India in people using the cryptocurrency. So in the budget 2022, the finance minister said there has been a phenomenal increase in transactions in virtual digital assets. The magnitude and frequency of these transactions have made it imperative to provide for a specific tax regime. So considering the high volume of the transactions, high growth of such cryptocurrencies and such digital assets, in the budget 2022, the finance minister said there is now, considering the phenomenal increase, there is a need to have specific tax regime. Accordingly, the finance minister said for the taxation of digital assets, I propose to provide that any income from transfer of any virtual digital asset shall be taxed at the rate of 30%. So this is the first time were brought to the tax net by taxing it at the flat rate of 30%. No deduction in respect of any expenditure or allowance shall be allowed while computing such income except cost of acquisition. Further, loss from transfer of virtual digital asset cannot be set off against any other income. Further, in order to capture the transaction details, the finance minister said, I also propose to provide for TDS on payment made in relation to transfer of virtual digital asset at the rate of 1% of such consideration above monetary threshold. Gift of virtual digital asset is also proposed to be taxed in the hands of the recipient. So this is the extract from the speech of the finance minister while presenting the Union Budget 2022, wherein for the first time virtual digital assets were brought to TaxNet at flat 30%. No deduction in respect of any expenditure or allowance was to be allowed. It was loss cannot be allowed to be set off. Further provision for TDS were made, and further gifting provisions were also made subject to virtual digital assets. So under the Income Tax Act, Section 2, subsection 47A was introduced to define the virtual digital assets. So let's first understand what is the definition of virtual digital assets as defined under the Income Tax Act in Section 2, subsection 47A. The section says that any information or code or number or token not being Indian currency or foreign currency. So any information, code, number or token generated through cryptographic means or otherwise by whatever name called, providing a digital representation of value exchanged with or without consideration, with promise or representation of having inherent value or functions as a store of value or a unit of account, including its use in any financial transaction or investment, but not limited to investment scheme, and can be transferred, stored, or traded electronically. So this is the first part of the definition, which reads that this part 1 of section 2, subsection 47A, any information, code, number, or token generated through cryptographic means, providing a digital representation of value, whether exchange with or without consideration, with promise or representation, and having inherent value or functions as a store of value or a unit of account, including its use in any financial transaction or investment, and which can be transferred, stored, or traded electronically. Second says a non-fungible token, NFT. We'll see what is called non-fungible token, what is fungible, what is non-fungible. We'll see that in the later part of this presentation. Then any other token of similar nature by whatever name code. The Act has defined non-fungible token means such digital asset as the central government may by notification in the official gazette specify. Any other digital asset as the central government may by notification in the official gazette specify, provided that the central government may by notification in the official gazette exclude any digital asset from the definition of virtual digital asset subject to such conditions as may be specified therein. So this definition is very wide. This definition covers anything, any information, code, number, or token which is generated to cryptographic means and which has got a digital representation and which has got a inherent value which can be stored and can be transferred or traded electronically, and also a NFT, non-fungible tokens, and any other digital asset which government may specify. So this is the wider definition of virtual digital assets. Now let's see the journey of cryptocurrency or the virtual digital assets in India so far. So in the how the concept of cryptocurrency started, it started in the year 2009. Somebody named Satoshi Nakamoto, presumably a pseudonymous developer. Pseudonymous developer means nobody in the world knows who is Mr. Satoshi Nakamoto. Is an unidentified entity, an unidentified developer who created world's first decentralized cryptocurrency named Bitcoin. So many people get confused about the Bitcoin. They say cryptocurrency is Bitcoin. No, Bitcoin is just one of the cryptocurrency, and there are now hundreds of such cryptocurrencies in the world. In the year 2013, Reserve Bank of India issued risk warning pertaining to the cryptocurrency. RBI cautioned the public against the use of such virtual currencies. The bank sent a message to the users, holders, and traders of virtual currencies. The circular issued was regarding the potential financial, operational, legal, customer protection, and security related risks involved in the transactions via virtual digital assets. So what happens? See, there are many people who buy cryptocurrencies. Some people buy cryptocurrency with knowledge. Some people buy cryptocurrency without the knowledge. Somebody has invested and somebody has invested some cryptocurrency and he knows that he has earned sizable money. So that prompts other persons without understanding the risk to invest in the cryptocurrencies. And today, the study says there are a number of cryptocurrencies which are just a fraud type of currencies where people have lost many of their savings. So that was the warning issued by 2013 by RBI to the public, cautioning them about the use of such virtual digital assets. In 2017, after 4 years, RBI issued another circular about its apprehensions on cryptocurrencies. RBI and the Finance Ministry warned that virtual currencies are not a legal tender. Subsequently, public interest litigations were filed in the Supreme Court seeking a ban on buying and selling of cryptocurrencies in India. Another PI was also filed asking for them to be regulated. So there are two different kind of public interest litigation in the two different directions. One says cryptocurrency should be completely banned, and another PI was filed asking them to be regulated. Then in 2018, RBI came out with a circular restraining banks, NBFCs, and payment system providers from dealing with virtual currencies and providing services to virtual currency exchanges. So RBI banned the banks and NBFCs from dealing with such virtual currencies. In 2019, the government presented the bill Binding of Cryptocurrency and Regulation of Official Digital Currency Bill 2019. The scope of the act was to impose a complete ban on all crypto-related currencies, including mining, buying, holding, selling, and dealing. However, somebody challenged the ban of the cryptocurrencies, and in 2020, the Supreme Court struck down the crypto banking ban. Supreme Court says that it's falls under the fundamental right of the citizens and you cannot completely ban the cryptocurrencies. So finally, in the year 2022, the income tax regime got introduced on virtual digital assets. So now let's see what are the different types of virtual digital assets. One is payment tokens. Payment tokens can be used as medium of exchange for goods, services, and also as a store of value. Then we have got utility tokens. A utility token is a crypto token that serves some use case within a specific ecosystem. These tokens allow users to perform some action on a certain network. Then we have got security tokens. Security token is a digital asset that represents ownership or other rights and transfer value from an asset or bundle of assets to a token. Then we have got property tokens, which gives rights in immovable or movable property. So property token converts the value of real estate into a token stored on a blockchain, enabling digital ownership and transfer. So let's understand these tokens a little bit in detail. First, we talk of the payment tokens. Payment tokens, as I said, can be used as a medium of exchange for goods or services and also as a store of value. So like Bitcoin is one kind of payment token. So payment tokens are used as an alternative means of payment and exchange. Unlike fiat currencies like INR, US dollar or the euro. Payment tokens are like Bitcoins. They are not legal tender and they are not backed by the government. Instead, their main objective is to be a decentralized tool for buying and selling goods and services without traditional intermediaries and have no other function or only limited functions. So payment tokens include like cryptocurrencies like Bitcoin, Monero, Ethereum, and many more cryptocurrencies which are built on their own blockchain and serve as a means of payment. So one kind of virtual digital asset is payment tokens, which we know like cryptocurrencies, Bitcoin, Monero. These are the very famous names. Then we have got utility tokens. It serves as a utility on the native blockchain. A utility token is a cryptocurrency on a smart contract blockchain that serves a specific function in a crypto project's ecosystem. So unlike cryptos like Bitcoin, utility tokens aren't designed to be a real world medium of exchange. So they're not a real world of museum, but it just provides utility. Utility tokens, they grant holders access to a current or prospective product or service, but do not grant holders rights that are the same as those generated by specified investments. So utility tokens are not mineable, like cryptocurrencies are mineable. Utility tokens are not mineable. They are usually pre-mined and they are created all at once only and distributed in a manner chosen by the team behind the project. Then we have got security tokens, which provide rights and obligations similar to securities or investments like shares or debt instruments. Tradable financial instruments, tradable securities like stocks, bonds, ETF may be tokenized to become a security token. So now the main difference between utility token and security token is that security tokens give rights of ownership to a company. Think of them sort of like digital decentralized shares of stock. Whereas security tokens are also classified as securities by the financial regulators like the Security and Exchange Commissions, making them subject to all the same rules as stocks, bonds, ETF and other securities. So now next thing is non-fungible assets. So what is non-fungible? So first, to understand non-fungible, let's understand what is fungible. So the concept of fungibility refers to the ability for an asset to be exchanged equivalent with another asset of like kind. So what is fungible? Fungible is an ability of an asset. So which has got like two assets which has got completely similar equality and which can be exchanged easily. Like if we call a practical example, fungible asset is like our Indian rupee. Now if I have got 1 rupee coin and I have got 1 rupee coin, 1 rupee note. So both have got exactly the same value. So whether when you can trade 1 Indian rupee for another Indian rupee, and we know that the value is exactly same. So whether I have got coin which was printed in say year 2022 or the coin which was printed in 2022 or 2020, the coin will have 1 rupee coin will have the same value, and that is called exchangeable exactly with the same value. So this is called fungible asset. So in contrast to that, non-fungible assets are valued differently based on their unique attributes and scarcity. So non-fungible asset would be just one asset. See, there are not different assets with the same attitude or same quality. So non-fungible assets have always scarcity because there are only one such kind of assets in the world. So non-fungible tokens are the blockchain based tokens that each represent a unique asset like a piece of art, digital content or media. And non-fungible asset can be thought of as an irrevocable digital certificate of ownership and authenticity for a given asset, whether digital or physical. Non-fungible essentially means non-interchangeable or unique. So each NFT is unique. So there is only one original, just like an artwork or painting. Like we know the Amitabh Bachchan's created his own, it's created his own NFT. So such NFT are only one. It can be copied. It cannot be duplicated. See, somebody can make a Xerox copy, so it's a copy, but it cannot be duplicated. Like if you see the website beyondlife.club, let me open the website. Just give me, I'm just trying to open the website. This is the website beyondlife.club, where you can own the NFTs of, I think this is screen is not there. Just a moment. Yeah. So here we can see like collections of NFTs of Amitabh Bachchan. Like here, the number one collection says Madhushala Poetry. Then collection 2 says Win with the Loot Box. Then collection 3 is Iconic Vintage Postage, hand painted and autographed by Amitabh Bachchan. Now let's try to see this collection. Now see, now this is the poster. Like Amitabh Bachchan, Jaya Bhaduri, JP Shriram, this is Solace. Okay, this was auctioned on 4th 11 2022 and it was sold for $94,000. Now this picture is would be called an NFT because this is just one unique piece in the world. Somebody can a make a color Xerox copy of this poster, but it will not be as original as this. It will be just a copied one, not the original one. So such kind of original ones fetch a higher value. Like this is the Big B Punks and this is like NFT art of Amitabh Bachchan. This was sold for $66,000. There are certain kind of other pictures also, other NFTs also, which get huge collection because of this inherent value. Just a moment. I'm trying to change the screen. Yeah. So these are the called NFT, and this falls in the definition of virtual digital assets. So now we have understood the difference between fungible assets and non-fungible assets. So non-fungible assets by its definition are called falls under the category of virtual digital assets. So what is legality of cryptocurrency? So in our country, there is no law dealing with legality of cryptocurrency. As we said in the year 2022, this was made taxable under the income tax law. But making it taxable under the income tax law does not deal with legitimacy of cryptocurrency. So there may be certain income which may not be legal, but those are taxable. So merely making those illegal income taxable does not make those income as illegal. So it can be said that everything which is not forbidden is allowed. So cryptocurrency is not declared illegal. So the same may be fall under the category of legal. However, the status of legal tender is not given to cryptocurrencies, and they cannot be used for banking purposes. We can do trading of cryptocurrency because it is not forbidden, it is not declared illegal. So trading of cryptocurrency can be allowed, is allowed, but it cannot be served as a legal tender. As he said, on 4th March 2022, the Supreme Court lifted the ban imposed by RBI on cryptocurrency. However, the judgment of the Supreme Court did not offer any guidance on regulation, but it simply invalidated the RBI circular on the basis that it impedes the fundamental right of those engaged in virtual currency related businesses without providing adequate rationale. So RBI said that this fundamental right that anybody can engage themselves in the business of virtual currency related businesses, and there is no rationale to prohibit them. So the Supreme Court merely lifted the ban, but so the judgment didn't offer any guidance on how the cryptocurrency should be regulated. And the government also did not clarify if the virtual assets will be a currency, commodity, or security. So in the absence of any such classification, the virtual asset shall be classified as a capital asset. So with this, as we said earlier, the gifting of VDA is also made subject to income tax. So let's understand the section 56 to 10. So this section is applicable when any person receives any benefit whose value exceeds rupees 50,000. So this is applicable irrespective of the residential status or class of SSE, like the donor or donee can be individual, partnership firm, LLP, company, AOP, BOI, cooperative society, or artificial judicial person, whether resident or non-resident. So the income in the hands of the recipient arises from the following transactions. Firstly, receive monetary benefit without consideration, receive immovable property without consideration or for inadequate consideration, and receive specified movable properties without consideration or for inadequate consideration. So there are certain exemptions if there is a receipt from a relative or under a will or under inheritance or from any trust or charitable institution registered under the ITA, then this section would not be applicable. So now VDA is included in the definition of property for the purpose of section 56 to 10 with effect from 1st April 2022. So this will make gifting of VDA subject to the tax. However, the receipt of VDS for no consideration or inadequate considerations prior to 1st April 2022 may not be taxable because prior to that, the VDA was not forming part of the definition of property in the section 56 to 10. So if any transactions which has happened before 1st April 2022, the stand can be taken that it was not falling under the definition of property. This VDA is not a property as defined under section 56 to 10, and so the provision would not apply. So in the crypto assets market, it is common for some crypto projects to airdrop their tokens. Airdrop can be understood as a crypto project sending free tokens to their communities in a bid to encourage adoption and in turn reward them. So in such case, if value of airdrop VDA exceeds 50,000, then it could be taxable in the hands of the recipient. So what happens to develop the own cryptocurrency and to for just a marketing purpose? The concept is of airdrop of tokens, right? These tokens would be given free of value. So airdrops can be subjected to tax under section 56(2)(10). So by notification number 74 of 2022, certain VDAs were excluded from the definition of VDAs, like gift cards or vouchers, being a record that may be used to obtain goods or services or a discount on goods or services. Then mileage point, reward points, loyalty cards, being a record given without direct monetary consideration or under an award, reward, benefit, loyalty, incentive, rebate, or promotional program that may be used or redeemed only to obtain goods or services or a discount on goods or services. Then subscriptions to websites or platforms or applications. So technically, if we see the definitions, then somebody can argue that such gift cards or vouchers are also virtual digital assets. So to clarify the positions, the government issued a notification specifically excluding such items from the definition of VDA. Another notification was issued in June 2022, which said that only those NFT trades that do not include a parallel sale of an underlying physical asset will attract the tax rates specified for VDAs. Like if an NFT is sold and legal ownership of the underlying asset is also transferred as per the due process, then tax rate would be determined as per the underlying asset and not as per the rates applicable to VDS. Like, see, the structure is made like this, with the transfer of NFT is also attached to some physical asset, and once the NFT is transferred, that physical asset gets transferred. So for taxation purpose would be deemed as a transfer of underlying asset, and accordingly the tax rate of underlying asset would become applicable. Like, see, if NFT of a piece of classic article is traded and the actual piece of classic art is also exchanged as a part of the transaction, then the sale of classic art will not attract the same tax as those applied to VDA. So this means that VDA shall not include an NFT whose transfer results in transfer of ownership of underlying tangible asset, and such transfer is legally enforceable. So this makes situation clear. If there is an NFT which is attached to particular asset and that transfer takes place, then it would be considered as the transfer of underlying tangible assets and not the transfer of NFT as a virtual digital asset. So how to consider fair market value of VDA? So if it is purchased from registered dealer, then the invoice value of such asset shall be its fair market value. Suppose if it is received in other mode, then fair market value of such asset shall be the estimated to be the price that would fetch if sold in the open market on the valuation date. And if the value of such asset exceeds rupees 50,000, then the SSC may obtain the report of registered value in respect of the price it would fetch if sold in the open market on the valuation date, because it's otherwise difficult to value the IFT. So where the invoice is there, it's registered from dealer, then invoice itself becomes the value. However, if there is no such invoice, then it's very difficult to determine fetch what will be its open market value. Like we see the examples of VDS of Amitabh Bachchan, it is possible to value them. So then a valuation report can be obtained in open market to arrive at the fair market value. Now about the taxability of VDA. The Union Budget 2022 introduced the section 115BH to tax the virtual digital asset. So now first let's read out section 150BBH for a proper understanding. So section 115BBH reads like, where The total income of an assessee includes any income from the transfer of any virtual digital asset, notwithstanding anything contained in the other provisions of this Act. The income tax payable shall be the aggregate of A. The amount of income tax calculated on the income from transfer of such virtual digital asset at the rate of 30%, and B. The amount of income tax with which the assessee would have been chargeable had the total income of the assessee been reduced by the income referred to in clause A. Part 2. Notwithstanding anything contained in any other provisions of this Act, no deduction in respect of any expenditure other than cost of acquisition or allowance or set off for any loss shall be allowed to the assessee under any provision of this Act in computing the income referred to in clause A of subsection 1, and B. No set off of loss from transfer of the virtual digital asset computed under clause A of subsection 1 shall be allowed against income computed under any provision of this Act to the assessee, and such loss shall not be allowed to be carried forward to succeeding assessment year. Now we'll try to see the implications of this section. So as per section 115 BBH, the income arising from transfer of VDA shall be taxed at the rate of flat 30% plus applicable surcharge and cess. Second part is no deduction is allowed. Only one deduction, cost of acquisition. Apart from cost of acquisition, no deduction whatever is allowed. So this is like, we can say this tax regime is like similar to the tax regime that currently exists in respect of taxation of winning from games. Like we see winning from games, lotteries, it's tax flat at 30% and with no deductions allowed. So before this regime came, it was possible to categorize transactions either as trading income and claim expenses or claim long-term capital gain rate of 20% based on the facts of the case. But with the introduction of section 150, now there is a clear-cut taxability guidelines that it would be taxed flat at 30% without any deductions. So it says no deduction in respect of any expenditure or allowance, set off of any loss shall be allowed, and no set off of loss from transfer of VDA shall be allowed against income computed under any other provisions of this Act, and such loss shall not be allowed to be carried forward. So the capital loss from the transfer of VDA cannot be set off against any other capital gain. Suppose if I have got capital loss by sale of VDA and I have also got capital gain, then I cannot set off, like both loss and gain falls under the one head only, like income from capital gain. But gain would be taxed fully, loss there will not be any set off. In other words, short-term capital loss from the sale of cryptocurrency cannot be set off against short-term capital gain from sale of listed shares. Similarly, the long-term capital loss from sale of NFT cannot be set off against the long-term capital gain from sale of mutual fund. So now, which is very clear, situation is very clear that even under the one head, income from capital gain, we have got capital gain from some other assets, and we have got capital loss from VDA. Both cannot be set off against each other. So now the question would remain whether loss from one VDA can be set off from the gains from another VDA. Like I have got two cryptocurrencies, like say cryptocurrency A and cryptocurrency B. On sale of cryptocurrency A, I have incurred loss, and on sale of cryptocurrency B, I have earned gain. So whether it is under the both are the VDA. So whether loss of cryptocurrency 1 can be set off against cryptocurrency 2. So there was a statement in the Lok Sabha by Minister of State for Finance, Mr. Pankaj Chaudhary. He said that as per the provisions of the proposed section 115BH to the Income Tax Act, loss from transfer of VDA will not be allowed to be set off against the income from transfer of another VDA. So now the situation is very clear. And loss of whatever nature, whatever head is required to be completely ignored. Like loss of cryptocurrency A cannot be set off against gain from cryptocurrency B. We need to pay tax at the rate of 30% on whatever gain we have got from cryptocurrency 2, and the loss will remain as a simple loss. So any loss would be completely ignored or disallowed. So it's like say, as we said, where suppose we earn a gain of 100 rupees on Bitcoin and we incur a loss of 10 rupees on Ethereum during the same year. So the loss of rupees 10 needs to be ignored and will be have to pay tax on the entire amount of 100 rupees. So while mining, there is a lot of infrastructure cost which is incurred. So infrastructure cost incurred in the mining of VDA, including cryptocurrencies, also will not be allowed as a deduction. Mining requires huge investment in computer, and it also required good amount of electricity continuously because there are heavy servers and which are required to be operated continuously. So the cost of computer or its depreciation or the amount of electricity bill is also not allowed as a business expenditure. Now thing is very clear, no loss, absolutely no deductions except the cost of acquisition. Everything raised will be taxed on a gross basis. Now TDS is also made applicable. The idea of, as we have seen in the chapter on the TDS, that the main purpose uh, behind applicability of TDS is to brought such income to the tax network. So once TDS is there, such income gets captured in the ecosystem of the income tax department and it cannot escape from the tax liability. So section 194S is introduced. It says tax liability is applicable when the payment for transfer of VDA exceed rupees 50,000 in case of specified persons and rupees 10,000 in other case. So any person responsible for paying to a resident. Now let's read out the section 194S. Any person responsible for paying to a resident any sum by way of consideration for transfer of a virtual digital asset shall, at the time of credit of such sum to the account of the resident, or at the time of payment of such sum by any mode, whichever is earlier, deduct an amount equal to 1% of such sum as income tax thereon, provided that in a case where the consideration for transfer of VDA is wholly in kind or in exchange of another VDA where there is no part in cash or partly in cash and partly in kind, but the part in cash is not sufficient to meet the liability of reduction of tax in respect of whole of such transfer. The person responsible for paying such consideration shall, before releasing the consideration, ensure that tax has been paid in respect of such consideration for the transfer of virtual digital asset. So this is very important. This section also applies to exchanges as well as individuals. This section is applicable to both cash and barter transactions. So the liability is very clear. TDS at 1% is required to be deducted. And whoever is responsible for making payment has to ensure that tax is deducted. Now, as we said, it might happen that one VDA is exchanged for another VDA, and so there is no payment in cash. So then, how to deduct TDS? Sometimes it happens that amount is partly in cash and partly in kind, but the portion of cash is lesser and the amount of TDS is higher. So the portion of cash is not sufficient to meet the liability of TDS. So in both these transactions, the duty has been casted on the person responsible that he has to ensure that tax has been paid. So either he needs to collect the amount from the persons and pay it or whatever be. But he has to ensure that tax is paid in respect of such consideration before the transfer of VDA takes place. Now let's try to analyze this. The person responsible for paying any sum to any resident with respect to transfer of VDS is required to deduct 1% tax on the said sum. Where payment is wholly or partly in kind, the person responsible for paying such consideration shall ensure that tax has been paid prior to releasing such consideration. Now there are exemptions. No tax shall be deducted under this provision if the consideration is payable by any person whose value does not exceed rupees 10,000 during the financial year, and the value of 50,000 rupees for specified persons. So who are the specified persons? Any individual or HUF whose total sales, gross receipts or turnover does not exceed rupees 1 crore in case of business or rupees 50 lakhs in case of a profession during the financial year immediately preceding the financial year in which such VDA is transferred. An individual or HUF who does not have any income under the head profits and gains of business or profession. So these persons would fall under the category of specified persons. And if the transaction has taken place with such specified persons, then TDS liability would arise only when the consideration exceeds rupees 50,000. 50,000 or more. If it does not exceed 50,000, no TDS requirement is there. So to make it simple, just a moment. So there is a payer. Payer can be company, firm or LLP. So in case of payer is company, firm or LLP, threshold limit would be rupees 10,000. If it is individual or HUF, and if it is specified persons, then 50,000. And for any other individual or HUF, it will be 10,000. So payer, company, firm, or LLP, then threshold limit is 10,000. If it is individual or HUF, then we have to see whether it falls on the specified category or not. If it is specified category, rupees 50,000. For others, it is rupees 10,000. So this is guideline issued by CBDT about the TDS. So trade where a broker is the seller. So tax may be withheld by the exchange that is crediting or making the payment to the seller. So whenever the transaction is taking place through a broker or through an exchange, then it will be the exchange that would be required to withhold the tax. Now where a broker is not the seller, then broker can take the responsibility to withhold the tax if there is written agreement between the exchange and the broker. And in case where VDA is owned by the exchange, then primary responsibility to withhold the tax is of the buyer or is her broker. Alternatively, an exchange may have a written agreement with the buyer broker that the former would pay tax, and the exchange would be required to furnish a quarterly statement in Form 26QF. So this is all about the TDS requirement for the VDA. Now where section 194Q and 194S both are applicable. So if tax is withheld under section 194S, so then there is no withholding required under section 194Q. And tax is required to be withheld on the net consideration after excluding GST or the charges levied by the deductor. And where the payment gateways are involved, so payment gateways are not required to withhold tax if the tax has been withheld by the payer. Payment gateways could take an undertaking to this effect from the payer. Now, certain disclosures are required in the income tax return. So, a taxpayer would have to report transactions related to cryptocurrency as business income if held as stock in trade, or capital gains if held as investments. So there are certain disclosures which are required for the VDA. If reported as business income, then ITR 3 form would be applicable. If it is reported as capital gain, then we'll have to use ITR 2. If cryptos are treated as investment, then long-term capital gains on sale of cryptos would need to be reported under CG schedule of ITR 2 or ITR 3, whatever be the applicable. It will be reported under the head from sale of assets section. Then short-term capital gains on sale of crypto would need to be reported in CG schedule of ITR 2-3 under STCG on asset section. On the other end, if it is treated as business income, then sale of crypto needs to be reported in Part A trading account under sale of goods in ITR 3. And the net profit loss from sale of crypto after reducing the permissible expenses, so permissible expenses are like the acquisition cost, need to be reported under the head net profit before taxes. So this is what about the disclosures in the ITR. So what we have seen in under this head, virtual digital assets. First thing is what are the different type of virtual digital assets? What is the legal scenario in the country? What is the taxability? What is the TCS requirement, and how it is required to be disclosed in the tax return? So this is what is all about virtual digital assets. I think there is nothing left about the taxation of VDA. So with this, the session is open.
Anybody has any question?
Topic today was very limited to talk about the taxation of virtual digital assets, and we have covered all the aspects of taxation of VDA, and we also tried to cover what is fungible assets, what is non-fungible assets, and what are the type of virtual digital assets. But mainly virtual digital assets, as far as we are concerned, would be mostly cryptocurrencies, where I have also seen that many professionals like us also deal with cryptocurrencies. They might have sufficient knowledge or might not have sufficient knowledge. And in my professional group, I have seen some people minting money, some people losing money. So we need to be always very cautious before we deal with any subject or anything with which we don't possess the technical knowledge. So anybody wants to have any clarity about VDA, the floor is open.
Anybody has any query? You can unmute yourself and ask the query. I think no query. I would like to
conclude.
Yeah, I think sir.
I will share my presentation on VDA. So if anybody has
no, you can send the presentation to WRC.
Sure, I will send the presentation to WRC.
All the presentation, we are in the process of uploading all the presentation on the WRC website. So members will get all the presentation from there.
Fine.
If anybody wants to listen the session
Yes.
We are uploading all the videos of our webinar on
Sure.
our YouTube channel ICAI-WRC CMA. You can subscribe to the channel and view the webinar. I will request all to subscribe to the channel so that whenever we upload a session you will get the notification automatically.
Fine. Thank you, sir. So with this, we end the session. Thank you for the participation. Thank you, sir.
Yeah, I would like to thank our speaker and all the participants and also WRC staff. Thank you.